Holy shit, guys, the stock market's on steroids, the bull market's gaining steam. We're up 40% in the last 2 months alone. And that reminds me of a video I did about 3 months ago where I took a Coke bottle and said that, the market's like this Coke in the bottle. It's stuck inside there. There's pent up demand. It wants to go higher, but it can't go higher. And what the Fed was doing is putting lots of stimulus like Mentos into the Coke bottle, right? Shaking the bottle every single day. And the moment there's optimism that the market or the economy is reopening, is going to explode. And that's your money shot, right? If you forget, here's a quick review of the clip.
Fed is pumping all these steroids into the economy. Now eventually when the crisis is over in 2 or 3 months, what's going to happen? It's going to happen to the stock market. The stock market's going to explode higher. So you can make a lot of money if you invest in the stock market before it explodes higher.
And those of you in my community and following me on Telegram, Facebook, and on YouTube would have seen that amazing opportunity where we got to buy great companies at ridiculous, massive discounts 2 months ago. And if you grab the opportunity, you should be pretty happy right now, sitting on some pretty good gains. In fact, one of my portfolios was just 700,000 2 months ago, and now it's up to about $1.15 million, right? That's about a 60% return in 2 months and growing at about 20K or 10, 20, 15K a day. And these are most of my positions. You can see bought them at huge discounts, and now when it rebounds, you make huge profits. So the way to make big money in the stock market is to buy when everyone is panicking and everyone is selling. That's how you get great discounts. And it's not just the stock markets that have been trending very strongly. Currency, Forex, has been trending really strongly as well recently, right? And through trading certain currency pairs, it's been pretty profitable. You can see this was just the last week of trading, right? Although it's a much smaller account, but making about 7 grand from taking small bites out of the market, just in and out, every single day, just in and out, in and out. So profits, some losses along the way, right? Sometimes you get a string of losses, you're gonna be a profits over there, right? So in trading, it's about making money lose and making a net profit along the way. And although growing your account and growing your wealth feels good, but what makes me really happy is when I see my community of students really benefiting and doing well during this crisis, right? This is Eduardo Lopez. He says, thanks to Adam Khoo and team, I'm kicking the market's butt, right? You can see his account is up 30% for the year, beating the S&P 500, the Dow Jones, and the NASDAQ. We've got Ming Tuo, and this guy's pretty cool because he came to my program when he was still in university. Some people think that I should only start investing when I've worked for years in my career, I've saved up a lot of money. But he started learning to invest and to invest even as a student when he had just a bit of savings at the time. And he said, hi Adam, I'd like to share my trading and investing results. He does both trading and investing. I took up your courses last year in August when I was a 3-year student of the National University of Singapore. I took a leap of faith and used almost all my savings to attend your course. I'm glad that I made the right decision. Up to today, despite the pandemic we are facing, my portfolio is up 33% since inception and up 68% year to date. Right? I'm graduating this year, really hard to find a job. Fortunately, I'm able to sustain myself with the money I made from trading and investing. Thank you for guidance and teaching along the way. You can see up 68% year to date. That's pretty amazing, guys, right? It's from John Twamley. Adam, I'd like to personally thank you. I'm very new to investing in the stock markets, and at first I tried to learn on my own. Lost a bit of money, and the best decision I made was to sign up for the value momentum investing course. In 3 months, I've more than tripled the course fee in the markets. Thank you, and I look forward to learning more from you. And this person, I think her name is Faith, posted this really sweet message on my Instagram account, right? Thank you, Adam, for being a wonderful teacher. And if you can't see that account, let me just flip it over there, right? Up 44.95% return for the year. That's pretty darn amazing, right? For these newbie investors and traders. During a time of crisis, and pandemics. This is from Sean, I think it's from Singapore. He said, hi Adam, you can post mine too if you want. I was up 45% last year, 2019, and year to date up 15%. Right? Prior to attending your course, I was only up 10%. In short, attending your class tripled my growth. Right? Love your investing playbook, slingshot strategies, and the strategies by Mr. Bang, who is our options specialist. Right? You can see his portfolio results, right? Up 15% year to date. Now, with the stock market up 40% in the last 2 months, and you know from my last video, and I said that the stock market is getting expensive, could it still go even higher? And the answer is absolutely yes. Here are 5 reasons why the stock market could go much higher. Let me make a disclaimer. I'm not saying that it will go higher. It may go higher. That's the difference. Why? Because I can't predict the future. No one can predict the future. And as an investor and as a trader, I never predict the future. Instead, what I do is I look at the fundamentals of companies, their valuations, and I look at the trends. I only invest when a stock is deeply undervalued. If it is not undervalued, I don't buy. So I was buying like crazy 2 months ago because it was deeply undervalued. So even though the stock market could be going much higher now, I'm not buying any more shares. Let me make it very clear. I'm not buying any more. Why? Because it's no longer cheap. I only buy when it's cheap. Asians only like to buy when we get a great deal, right? So I'm not buying anymore. Okay, at the same time, I always look at the trend. As traders, we follow the trend. We don't argue with the trend. As long as the trend is bullish, it means the market will keep going up. And the trend will continue until it doesn't. So people ask me, Adam, so when are you going to sell? When are you going to short the market? The answer is when the trend changes. When the trend reverses from an uptrend to a downtrend, I'll use put options to short the market. I'll take some profits on my stocks. When will that be? I can't predict the future. Could be 3 months from now, could be 3 years from now, could be 10 years from now. We follow the trend all the way to the end. So I'm here to share with you that, hey, the market's really expensive right now. It's rebounded 40%, but here are 5 reasons why it could still go a lot higher. So the first reason why the stock market could go a lot higher is because of technical momentum. Now, what does that mean? Convoluted word, right? So as you know, a lot of people, they were expecting that this rally over here, this short-term rally, was a dead cat bounce. In other words, it was going to go up for a while and boom, collapse all the way back down. That's called a bear market rally. Everyone expected that, right? And people expected that it's only going to go up to, at the very most, the 61.8% Fibonacci retracement level. Because if you study wave patterns, you know that the impulsive wave goes down, then it retraces to a Fibonacci level, like the 38.2%, 50%, 61.8% Fibonacci level, and boom, goes down. So did that happen? No, it didn't happen, right? So you can see what happened was the market went down, it went up, right? Initially to the 50% Fibonacci level, found a little bit of resistance, broke through that, and then it went to the grandfather of all resistance, the 61.8% Fibonacci level. And it couldn't break it, right? It made a first attempt, second attempt, and then boom, it broke that level. And once the market breaks a strong level of resistance, you've got extremely powerful technical momentum, all right? And sure enough, boom, it flies up. And now that the market, the S&P 500, has crossed the 200 moving average, that is a very, very powerful bullish signal in the markets. And for now, there's no more resistance that's stopping the market from going higher, right? Initially, the moving averages acted as resistance. The Fibonacci levels acted as resistance. Now there's no more resistance. It's clear skies ahead with the price above the 200 moving average. So statistics and probability tells us that based on these technical signals, the market is more likely to go up then go down from here. Now, having said that, remember that nothing goes up in a straight line, right? It will not just, whoa, go all the way up there, right? It's going to follow the wave pattern. So remember the breathing patterns I taught you before, right? Breathe out. It's going to breathe in, breathe out, breathe in, breathe out, breathe in. So there'll be pullbacks along the way. So if I'm trading it, I'm not going to jump in just because it went up. I wait for retracement, a pullback to a level of support, and I get in for the next ride up. All right, so that's the first reason. The second reason why the stock market can keep going up is because of the Federal Reserve, the Fed. The Fed has unleashed and launched unlimited quantitative easing. What does it mean? It means the Fed has the power to print unlimited money and use the money to buy up risk assets, to buy up equities via ETFs, to buy up bonds, to buy up any shit they can get their hands on, right? So as the Fed keeps pumping money into the system and buying, bonds and shares, of course it's going to go up. So investors and traders have now realized that the Fed will do whatever it takes, a la the Avengers, to ensure the market goes up. That doesn't mean that the market can't go down. Of course, the market could suddenly plunge again. If there's a second wave, then it's more bankruptcy. Sure, it could plunge again. But the Fed has already said, no, we're going to do whatever it takes to pump the market back up again. So you know what? Love them or hate them, you can't fight the Fed. They've got unlimited money. If someone has unlimited money, they can print money to buy whatever they want, to push the price up. Why fight them? Just enjoy the ride. So like it or not, for the last, 50, 60 years, the Fed has rigged the markets. They've rigged the markets to always go up. So why not get rich knowing that? So the more money the Fed pumps into the system, the more asset prices will rise. Real estate prices will rise, stock prices will rise, everything will rise, right? So an increased money supply increases asset values, like stocks, like equities. Now, there's a way for us to calculate where stock prices can go to based on the current money supply. And what we do is we can calculate what is known as a price to liquidity ratio. Share prices as a ratio to money supply. So the way we do it is we take the S&P 500 market capitalization, which means the market value of all 500 companies in the S&P. And we divide it by the Federal Reserve M2 money supply. And you plot it on a chart. So you can see that based on the last 20-year average, right, based on the money in the system, share prices on average should be here, which is this yellow line. That's the average for 20 years. And right now, we are only here. Ta-da! Which means that based on money supply in the system, share prices historically have quite a lot more room to run to the 20-year average, even going up to the highs over here that was seen in 2017, 2018, and 2019. All right. The third reason why the stock market could go higher is because most retail investors are still bearish. They are still short. Now, again, I've said this many times in my previous videos, right? And if you remember, what I said is that the market tends to move in a way that screws most of the people most of the time. The market tends to move opposite of what the majority of people think. So if everyone thinks that the market is going to go down, market goes up. When everyone thinks the market is going to keep going up, market goes down. It goes the opposite of the retail majority. And again, I've done a very detailed explanation in my past videos. Go watch it, right? Now, again, this is updated as of today, the 4th of June. And this is the IG Client Sentiment Indicator of the S&P 500. So you can see that red represents traders who are net short in the market, who are bearish. And again, blue are traders who are net long in the markets. So you can see historically when there are a lot more short than long traders. More people are bearish than bullish. The market goes up. Now, currently, where are we? As of today, you can see the number of short traders who are bearish. Again, they outnumber the long traders. In fact, retail trading data shows that 23% of traders are net long. In other words, they expect the market to go up. And 70% of traders are net short. They are betting the market will go down. And the short to long traders are 3-1. All right. So again, like I said, the stock market's like a bus. When there are very few people on the bus who have bought stocks, the bus can keep going up the hill because it's light, right? But as more and more people get on the bus, as more and more people buy stocks, what happens eventually? The bus gets full and it can't go up anymore and it collapses. So the moment I see that the number of long traders begins to go and it's going to reach the short traders, that's a clue the market's going to turn back down again. Here's another interesting chart. This is from CFTC. And you can see that the number of traders who are short the S&P futures are at a historical high right now. Okay, right now we are here. Can you see that? And as of now, or rather the last month, you can see that in terms of people shorting the S&P 500, taking short positions, it is over here. All right, it's at the extreme levels of short positions. Again, people are very, very bearish. And the more people are bearish, the more the market goes the opposite, goes up and screws everyone else. All right, that's how the market works. I love it or hate it, that's how it works. All right, here's another interesting thing to look at. Global investors tend to invest and allocate between bonds and equities. All right, and you can see that currently we are here right now where most global investors are underweight equities and overweight bonds. In other words, most global investors don't have much money in the stock market. Why? Because they're scared. They're keeping cash at the side and they have a lot of money in bonds. And now that they realize, hey, the market's going up, I'm getting more confident, what do they want to do? They want to sell their bonds and rotate into equities. They want to take their cash and put it into the equity markets. So historically, you can see that global equities as a percentage of total holdings is actually below the historical average. Historically, global investors have about 44% invested in stocks, but right now they only have about 40%. That's right. So we expect more money to flow into the stock market and it will then rise. Now, of course, if it rises too much and again, too many people get on the bus, then whoa, it's going to tip over, right? So when that happens, I'll let you know. Reason number 4, stock prices may look relatively expensive based on PE ratios, but stock prices are cheap relative to bonds, all right? Why? Let's take a look. Because the dividend yield on the S&P 500 exceeds the dividend yield on 10, 20, and 30-year treasury bonds. So if you look at the S&P 500, the current dividend yield over here below is 1.91%. All right. Now compare that to alternative investments like investing in US treasuries or US bonds. And you can see that the 30-year bond only yields 1.56%. The 10-year bond yields 0.77%. So ask yourself this question. Would you like to buy a US bond, lock in your money for 30 years and get 1.5%, or 10 years to get 0.77%? Or would you rather put your money into great businesses that can grow in value at the same time return 1.9% in dividends, and the dividends can grow as well? It's a no-brainer, right? So you can see that equities are cheap relative to treasury bonds. And historically, as long as whenever the dividend yield on the S&P exceeds the yields on treasury bonds, right, stock markets tend to go higher. All right, reason number 5. History says that we should go higher, right? Now, in the last 50 days, we have made the largest percentage gain in the history of the US market, all right? And if you look at all the previous histories of the market, whenever the market gained more than 20% over 50 days, and again, it happened 1, 2, 3, 4, 5, 6, 7, 8 times in history. Whenever it happened, and again, sorry, this is based from 1950, right? Whenever it happened and we had at least a 20% gain in 50 days, you can see that, 12 months later, the market gained additional returns, and it happened basically, right, 100% of the time. 1, 2, 3, 4, 5, 6, 7, 8. Sorry, 7. 7 out of 7 times it has happened. Of course, there's no guarantee it's going to happen again, but the point is that history seems to be on the side of it going higher. All right, so with that, let me just summarize what I'm saying. I'm saying that the markets have gone up quite a bit. They're not cheap anymore, they're expensive, but there are reasons why they could keep going higher and higher. And again, let me make some really important disclaimers. Disclaimer number 1, no one can predict the future. All we can do is to look at probabilities. So right now, the probability is that the market is more likely to go higher than go lower. But it's not a guarantee, because anything can happen in the markets. Anything can happen. So as an investor or trader, you have to be very, very flexible. So the moment I see that a market is reversing into a downtrend, whenever it happens, what am I going to do? I'm going to short the market by using put options. I'm going to protect my portfolio. I'm going to take some profits and short and make some profits as it goes down. When will it happen? I don't know. But I watch the price action and I let the market tell me where it's going before I take a new trade. The other disclaimer I want to make is that I've bought all the stocks that I want to buy 2 months ago. I'm not buying anymore. Why? Because prices are expensive. I only like to buy when it's dirt cheap. So I'm not going to buy anymore, even though I think it's going to go up. I'm just going to enjoy the ride, right? Having said that, if I want to add more shares into certain companies, I have to wait for a pullback, right? Remember, breathe out, breathe in. Wait for it to pull back to a support level before I add more shares. Never chase the girl, all right? Never have the fear of missing out, the FOMO. Never chase the girl. If you chase the girl, she'll never respect you. In fact, always wait for the girl to run to you, right? Let her run into your arms when she's fearful. Remember, there'll always be bad news that comes again. I don't know when, but whenever there's bad news and a girl runs to me, I'm waiting for her with open arms. Like what Richard Marx says, I'm right here waiting for you. All right, so hope you enjoyed this quick update, and I'll see you in the next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.